welcome to the live stream. Let's see what the market's doing today and see if there's any opportunities to get into some stocks. To evaluate stocks and look at their fundamentals. Sometimes stocks are popular, but I want to make sure they're valuable. But I want to make sure they're valuable. If you look at the best companies on the stock market, the most valuable ones, they all produce high free cash flow. High free cash flow. That's why I'm looking for high free cash flow. All the best investors depended on free cash flow and evaluating a company's ability to generate free cash flow. A company is not the stock price, and the stock price is not the company. They're two different things. Two different things. The big cap stocks have taken the show, but are big cap stocks gonna come back? Gonna come back? Chinese stocks are exploding. The dragon has awakened in China. It could be the best trade we've seen in a while. AI hype is really interesting. AI is going to be interesting in the future, but is it really a business today? I'm going to pass on this stock. Just not enough discount, and I'm not really believing that they're going to grow as well as they should. Options can make your performance go a little higher every month and generate nice income. Listen to the great super investors. They are pretty generous with their knowledge and their wisdom. You just got to read their books and listen to their videos. Learn something new every month. In investing, you'll become a great investor. You'll build wealth. This is a buy stock. You're looking at a discounted stock, and it's unappreciated at this time. Don't forget about bonds. Bonds are a smooth, consistent way of earning a good return. And when stocks are really crashing, bonds stand up tall. Bonds stand up tall. You got to ring the cash register and take a gain. Defining when to sell a stock is a lot harder than determining when to buy a stock. And over time, you'll become a great investor and you will build great wealth. Hey, good evening, everyone. Welcome to the evening live stream. We're going to talk about stocks. We're going to analyze them. It is a market that is in the mood to sell off. 2 days this week have been pretty good sell-off days. In between the two red days was a nice green day yesterday to kind of bring some stock prices up a little higher. Is this the beginning of a bigger correction? I don't know. I wouldn't be surprised if it was. We are dealing with a market that is expensive, considering that for the 1 year, the S&P is up 13%, but really collectively over 5 years, it's doing terrific. If you look at the NASDAQ, it's even accomplished far more. So we have been in a period of time where you could really build wealth. You can let your investments compound, just keep building, keep making your portfolio bigger, more valuable. All that means is it gives you more freedom to maybe take trips, retire, fund something you want to do, start a business, send a kid off to college, you yourself go to college. Just do things that you want to do. That's the freedom that wealth will bring you. And of course, you could also buy stuff with it, right? If you want to buy a nice car, nice house, or whatever it be, you can do that as well. And over the last 5 years, we've really enjoyed a great period of time. So if we have a correction, no big deal. No big deal. Maybe it'll reduce the stock price for a company that is a real good company, and it makes it into a very good investment. That's what corrections do. It's kind of big opportunity disguised as bad news. So that's what's going on the stock market. What's been interesting is we've had some stocks announce, and the announcements of their earnings were quite positive. You have earnings, for example, coming out of Palantir, and the earnings were good, but I guess the stock price was a little too high, and Palantir has been selling off 3 straight days. It's been pretty good sell-off in Palantir stock. Robinhood had terrific earnings announced, but that stock's a little expensive. It sold off. And I can go on and on. I can give you a list of 20 stocks. Uber, add Uber to the list. Qualcomm, add Qualcomm to the list. Just a lot of stocks that had good earnings, but I think the market, caught itself, and it's pumping the brakes. It's pumping the brakes and saying, hey, you know what? Let's just sell some stocks right now. Its market overall is a little expensive. So that's what's going on with the stock market at large. There were some green pockets today. Energy looked like energy prices were on the move higher. So they created a little bit of a rally today in energy stocks. The 2 big weight loss drug companies, Eli Lilly and Novo Nordisk, made a deal with the U.S. government to have lower drug prices when it comes to the weight loss drugs. So the whole space is now rallying around that, which is pretty interesting to see that space rally. It hasn't been doing all that great for the last 3 years. So a rally in that space is probably needed. And just couple more green pockets. Berkshire is up. We're going to get the first investor letter from the new CEO that's taking over Warren Buffett's post over at Berkshire Hathaway. That'll be interesting to read. I think it's coming out tomorrow. We shall see. JP Morgan had a good day, and so did Bank of America. So it was a pretty good red day, right? NVIDIA was down quite a bit. Meta was down. Tesla was down. Microsoft was down. So those some pretty good red days, and Amazon was down. So that's where we're at as a whole. When we look at the most valuable businesses out there, it looks like NVIDIA is still incredibly valuable, $4.57 trillion. It's up 40% year to date. It's doing great. PE ratio is a little high at 53. Apple, it's not doing great. It's not keeping up with the S&P. And it has a very high PE. So it's underperforming, and it has a high PE. For a slow growing company, that's a high PE. Microsoft is growing much better. They're doing okay. 18% is a good rate of return, and PE ratio of 35. Google Alphabet. This has been my pick for the last 4 or 5 months. I put a lot of capital into Google Alphabet, and it has rewarded me. It's up 50%, year to date. And if you really go back like 4 or 5 months, and if you bought shares at that point, you're up more 60, 70% since that time. So Google Alphabet was a really, really nice opportunity. The market was really doubting Google Alphabet, thinking that, that company isn't going to get AI right. So that's been a really good performer. Amazon is the next company I'm saying. That company is so mispriced. It's discounted. I'm buying Amazon stock. Every day that it's down, I buy a good number of shares. I bought a good number of shares today, and I'm going to build this up. This is going to be one of my big positions. My big positions currently are with Google, Meta, Robinhood, Uber, and a couple of others. And I want Amazon to be one of the big positions in my portfolio. Broadcom was down a bit, but it's having a terrific year. It's leading all the big caps with a 53% rate of appreciation year to date. Very, very nicely done. But it also has the highest PE of the top 7. You got to get down to Tesla with the ridiculous 290, 292, and they're not growing. So how does a company that it's not growing have a 292 PE ratio? You'd have to have a Tesla investor, somebody who believes in Tesla, explain that to you, because I cannot do that. I am not a believer. I have not found religion, the religion that is Tesla. TSM's having a great year. So overall, these guys are, getting a little bit of a sell-off, but you see that the numbers are just terrific for the most part. So nothing to be overly concerned about. If anything, it's a good thing to have some stock prices that are more rational. Today was kind of a high volume day for the number of earnings that were announced, but no big ones. There was no gigantic ones, right? The name that I'm following is Airbnb. We're going to jump into Airbnb in a few minutes. But other than that, I don't see any big names. Like last week, we had some humongous names, really interesting companies to cover. Not this go around. We are just dealing with the high volume, but low, the names are not that famous. Looking at tomorrow, Constellation Energy is going to announce, KKR, Enbridge Energy, Duke Energy, Brookfield, and a bunch of others. So let's focus in on what we got here on the table. I've got a list of stocks that I wanted to cover. Airbnb, AppLovin, Robinhood, Qualcomm, Allstate, Pinterest, and Duolingo. If there's a stock you'd like to look at, I'd love to hear about that. If you're a member, you know the drill. Just pop it in the chat. We'll take a look. We'll review it. We'll analyze it, see if we can do a valuation on it. If you're not a member, no big deal. You can play with a $5 super chat, and then I'll take a look at your stock, or become a member on the fly. It's easy. It's easy. I put a link at the very beginning of the chat. You can take a look at that. So it looks like Dre Generation X is on. Good to see you. And I, in the background, have the football game playing. It's not going to start for another 20 minutes, but we're going to have the Raiders and the Broncos play on Thursday Night Football. We will see who wins that battle. The Broncos have been a surprise this year. They are having a very good season, and it's a young team. I think they've got a lot of potential. They're going to be good for a while. Looks like we've got a couple new names. Thanks so much for joining. Looks like Jeff, thanks for joining. I agree with you on Qualcomm's earnings. I thought they were good. And Essence of Bitcoin. I have a valuation on Amazon. Buy a $5 super chat. We can take a look at it. Go from there. Thanks for joining. Falls Grave. Let's look at DraftKings. So they announced, and this is kind of the theme this go around. A company announces they have good earnings, the stock sells off. That's what I've been seeing. So let's look at DraftKings. They had some good news because ESPN moved from, I think it was Penn Gaming. They used to have Penn Gaming take all their bets, and they're moving over to DraftKings. So that was good news. So let's take a look at DraftKings, and I'll put that on the list. Yeah, the Raiders having a rough year. Man, the Raiders, they don't have a quarterback. They don't have like a long-term team right now. It's kind of just a lot of players that are brought together. We'll see when they put it together. And they have a tough division, of course. They've got those Chiefs that are good. Broncos are looking really good. And the Chargers look good. So we'll see what happens. Let's take a look at Elf. DJ, good to see you. Thanks for joining. We'll take a look at Elf. Now, is Elf the beauty company that was getting killed? Yeah, I think I saw that. Did they lose like a third of their value? We'll take a look a little later. All right. Yeah, so Robinhood does have prediction markets. They actually, what Robinhood did is they have a partnership with Kalshi, and it's not Robinhood that's got the platform, but they're selling it, which is smart. That way they go to market very quickly. And they definitely are taking a lot of contracts, which are bets for football games, political outcomes, social outcomes, all kinds of stuff. So it's been interesting to see that evolve. All right. So I checked on the chat. Keep it coming. Let's make this live stream interesting and let's get into some stocks. I'm going to run through some here and then we're going to get to DraftKings and ELF. But I've got a couple that I wanted to cover just to come off the bat. I'm ready to go here. Let's talk a little Airbnb. Who hasn't been in an Airbnb? You can go and you can rent somebody's house in a city. I like this experience. And Airbnb, I've gotten to know really well because I owned 2 properties in the mountains outside of Southern California, and I put them on Airbnb. I did really well, really good cash flow. I sold those 2 properties and have since stopped being a host, a property owner, putting it on Airbnb. But I've got to know them. I got to know how dominant they've been in the private home rental market. And since then, I've been a stockholder. So I know the company well. And as a traveler, whenever I travel with my family, it seems like we always stay in an Airbnb because it's more comfortable. We get better square footage and the experience, I think, is better. You kind of stay in a neighborhood versus hotels tend to be in a commercial district. You don't really get an experience in that city. Of course, like a New York City is different because everything's together. But when you go to maybe a smaller city or a town or maybe an area that is more rural, well, Airbnbs are a great idea. So I like the company. I like what their business model is all about, but the stock has just been a dog. Look at this. I showed you earlier that some stocks are up 50% and Airbnb is just dogging it, man. Not getting it done for investors, but they are catching a little rally in after hours. They announced their earnings after the market closed today. And so far, so good. The stock's up 5%. I read their earnings report. I think it's a good one, 10% top line growth. And these guys make a lot of profit. We'll take a look at that in a few minutes. $74 billion market cap, PE ratio at 28.7 and a 25 forward PE, which isn't too bad. And when they look at forward PE, that's 2026. So that's like 2 months away. So it's right around the corner. And the analysts believe it's discounted by 20%. I agree with them, and I'll show you my valuation in a few minutes. These guys have been growing. Last year, they grew by 12%. As we look at the quarterly, they grew almost 10%. Quarter before, 12.6. So they are growing. And these guys, their profitability is stupendous. Stupendous, if I may say, if I may use that word, because when you have 83% margins, you're in the stupendous category. In my opinion, you're growing well. It would be nice to see them grow at 20%, maybe 30%, but they're growing at 10% and they have a very good profitability and they're getting that profitability down to the profit line. And look at this cash flow, 38.4% yield of cash flow from their business. That is excellent. Just really good, profitable business to be an owner of. So that's why investors are picking up shares in after hours. They're like, hey, this is pretty good growth. Very good, top line growth, 10% isn't bad, but the profitability down below just looks awesome. When we look at this business, they have almost all cash on the balance sheet, almost no debt. So it's got a really good balance sheet. They should buy back more shares or maybe acquire another business and make their business bigger. Maybe they could acquire Lyft. That would be a good acquisition. Now, these guys, 29 analysts are covering the stock. Some analysts believe, hey, it can go up to $200 a share. Some analysts say it can drop to 103. So the downside isn't too bad. It's almost down to 103. They're going to keep growing by about 10%, and their profit's going to expand. So their PE ratio will drop unless the stock price rises. And I think the stock price is going to rise for our friends at Airbnb. I think it's a good company to have in my portfolio. And I think that it is discounted. Let's take a peek at my research, my valuation, and the price value comparison. I think it's discounted by 38%. I think each share is worth $192, but it's being sold for $120. The cash flows are really valuable. The earnings per share get me about a 13% discount. So I'm right there with the rest of the analysts, but this is where most of my value of a business comes from, is from that free cash flow, looking at a forecast, future free cash flows. So with this kind of discount, I am a buyer of Airbnb. I think it's a good stock to load up on, and I'll be happy to load up on it. I was getting a little concerned with Airbnb because they were beginning to kind of slow down, but I think this quarter was a very good quarter, and I'm good with the stock. I think I'm going to expand the number of shares that I own and own more Airbnb. But this is it's good to see that a stock is rallying higher. Good earnings, stock should rise. So it's interesting that some are being sold off, like in the case of DraftKings that we're going to look at later. So that is Airbnb. And looks like we've got some comments coming in. Awesome. You want to look at Snap? We can put Snap on the list. You know, I heard that Snap did a deal with one of the AI companies. Was it Anthropic? They did a deal with them. That's going to really help them out. And it looks like you'd like to look at Workday. Yeah, glad to do that. We'll look at Workday. And that is a software company. Good to see you. Osvaldo, very good to see you. And Airbnb is back in business, renting out privately owned houses to travelers, people that want to stay somewhere. Very good. All right, so let's move on from Airbnb and take a look at Allstate. So Allstate is an insurance company. You're probably familiar with the commercials. The insurance companies tend to make funny commercials, and Allstate has a pretty funny commercial themselves. This company, the stock did go up on a day when it was pretty red out there. It went up 1.67%. They announced their earnings yesterday after the market closed, and the market liked what they saw. I also liked what I saw. They pay a nice dividend, 2%, $51 billion market cap company. Over the past year, the stock's up 8.58 year to date, up 2%. 5 year, this has gotten it done. When you appreciate 115% and you pay a dividend, mission accomplished. I am a happy Allstate stockholder. Now, these guys, when we look at their forecast, analysts are saying, hey, it's discounted by 17%. All right. And they're going to keep growing. They're going to keep growing. And they're a pretty big outfit. They're at $64 billion in revenue, or they will be $64 billion in revenue here in 2026. They're going to keep growing that. Profitability is there. And look at the PE, 8.5 for 2026. That's really, really low. So Allstate overall, and I've got a pretty good little research page going on Allstate. So Allstate, in my opinion, is really discounted by 59%. The cash flows are very good. They're higher than I expected. The earnings per share drives a nice discount. And I rank the insurance companies, and I kind of put, the bigger insurance companies and kind of compare them to one another. Some key metrics compare on PE ratio. Allstate has the best PE ratio. The combined ratio is specific to insurance companies. What it basically means is, are they paying out, like in the case of Progressive, the reason why that stock's struggling now is that it pays out 100% of the policies it sells. Well, you're not going to make any money if you're paying out 100% of the policies you sell. So that's a bad number. You want this number, the combined ratio, to be as low as possible. So The best company out there is Palomar Insurance, but Allstate is there with an 89, and that's a decent combined ratio. They're making money. Return on equity is decent, not number one. That would be Progressive. And then price to book came down. So I rank them as my number one insurance play. And I am an investor and glad that I bought the shares. And I'm a buyer of Allstate. I think they came in with a very good earnings, and I think it all looks really good. So nicely done to the Allstate team. All right, so we got through Allstate. Let's go one more on the ones that I prepped. Then we're going to jump into some requests. Next one up is going to be AppLovin. AppLovin has been on a tear. Just get out of the way. Here comes AppLovin. It's going to bully its way up to the top. It is going to go 276%. And they did it the right way, which is through very high revenue growth, very high profit, very high free cash flow, terrific balance sheet. And they are just killing it when it comes to their revenue. We have a business that has very high growth. If you look at the growth that it's had, and I don't know that I agree with that there. When you look at the revenue growth that they announced on their earnings announcement, for the quarter, they grew 68%. 9 months growing 72%. Those are fantastic numbers. And they're a pretty big outfit now. It's not like a small number and they're just barely growing, by a little bit. They're growing a lot on a bigger number now. Free cash flow is terrific. So I read through their earnings announcement, and AppLovin earnings were terrific. The stock was up more than the 0.7% today. It was up upwards of like 5%, but then it settled down because the market was in a sell-off. That's fine. This stock's been on a tear. I'm glad I own it. It's a really, really good stock. And the market cap is 210 billion. P ratio is really high because that revenue growth is really high. Analysts think it's fairly priced. I showed you the revenue growth, the forecast. 20 analysts cover it. Some analysts think it could go higher. Some think it can go way lower. And they think it's fairly priced if you consider just a 2.6% discount. Now, the growth has been just phenomenal. They're going to keep growing at a very good rate. They're going to be over $12 billion in revenue here in FY 2028. And their P ratio is going to drop. Now, this is a software company that has terrific margins. When you examine their margins, they're up there. I think they were either 75 or 85% margins. Let's take a look at their margins. Gross margin, 79.69%. Profit margin, 44.8%. Those are awesome margins. Free cash flow, 53.8%. So when you're growing that fast and you make that kind of profit, free cash flow, it catches my attention. That's why I bought their shares. That's why I own their shares. And that's why I'm buying more shares of AppLovin. Terrific company. Go AppLovin. All right. So that was my lead off. Now let's go with, let's take a look at DraftKings. What's going on with DraftKings? I haven't looked at their earnings. Let's see here. November 6th, so they announced they're down 7.58. What is going on? What is going on with DraftKings? I'm going to get to the heart of the matter here. Go to their earnings. Let's read it together here. What's going on, DraftKings? So these guys are so revenue increased 4%. Okay, now that's underwhelming. So that's first problem is not a lot of growth. If you're not growing in this space, that's a sign that your competition is taking share. Okay. So they're guiding. So for the full year, they're going to grow 24 to 28% compared to the full year of 2024. Okay, so slow growth in the quarter. All right. So balance sheet isn't going to have much of an impact. I can look at that later. So yeah, this growth, I think that's why the stock's selling off. Why didn't they grow anymore? I mean, the last 3 months, you had baseball going on, you had football going on. Basketball started, but I don't know that they got much of that. So that is a concern. That top line revenue tells me, does the business have momentum or it doesn't, right? If it's not showing growth, that means there's no momentum. And Kalshi and Polymarket have a lot of momentum. So their cash flow does look good. 342 million in free cash flow for the first 9 months with very little capex. So that looks good. Let's take a look at a couple other things around DraftKings. So stock selling off 7.5 year to date, not good. 1 year, not good. So collectively, tomorrow, if this holds, it's going to be down 30% or so. The forward P is 39. I mean, if you got to start growing, because a 39 means you're growing. Okay, it doesn't mean you're growing at 4%. It means you're growing at 24%, 14%, and it looks like for the quarterly, that's where you had that low number, and that's a surprise, and that's concerning. Looking at the trailing 12 months. The revenue is slowing down a bit. Free cash flow of 654 for the trailing 12 months. All right. I will note that. All right. And then let's take a look at the forecast. So we have 28 analysts covering it. Everybody has a price target above it. 87% discount. Wow. What a discount. That's all predicated or based on earnings per share. And this is the earnings per share for the current year. It's supposed to really jump up in profit in 2026 to $1.19 per share, then $2.10, and then $3.50. These numbers look good, really good. Nice growth. And if the stock stayed at the same price, it would go down to an 8 PE. That's not going to happen. Stock price should rise. If these guys can hold it together and start growing, this isn't a bad idea. This is a pretty good idea stock. So what do I want to look at? So I want to look at their balance sheet just to remind myself what kind of debt they have. Debt is bad. I don't think many people would argue with me that debt is bad. And these guys have very little debt, just a little bit of debt here. They have almost as much cash as debt. So we're good on the debt level. All right. So we're good there. Let's take a look at my valuation on DraftKings. I have it and I can update it. All right. So okay, so last time I updated it was on the 30th of September. We're going to update it tonight. Now, I have a higher discount rate because I view DraftKings as being at risk. You've got these new players coming to their space, taking away market share, really putting a strain on the business. So I'm going to keep that for now. It is growing their free cash flows. Cash flows came in, and the trailing 12 months is lower. No, it's higher. I apologize. 654. Now, the growth rate, I'm gonna bring it down a little bit to 20% because the growth did surprise me to the downside. So let's kind of work with our forecast and be realistic. Okay, so that's our forecast. Now, cash, these numbers are not changing. We're good there. This number is a little bit lower, but no big deal. And then long-term debt of 1.9 billion. So if I measure the cash value, the net present value of cash discounted by 9%, we're at a 34% discount. And if I change that to the best number I'm putting out there these days is 7.5. Somebody who's got a terrific balance sheet, a solid business with momentum, I'd use the 7.5. So for these guys, I'm going to go with 8.5 because I think they're going to be fine. They just have some risk that maybe they're not going to grow as fast because of the competition with Polymarket and Kalshi. Hopefully they can figure out how to be more competitive, but we shall see. So let me look up their earnings per share on another screen real quick, and then I can update the full valuation. Next year, they're going to be $1.19. That was a little bit of a write down. They're growing, so 25 is fine. They're going to grow that earnings per share really well. So this is a discounted stock, and this is really it's in your hands as an investor. If you believe that the DraftKings business is going to grow, they're going to deal with these prediction market competitors and continue to grow, then this is a pretty good little opportunity. But if you think that they really are under threat and Polymarket and Kalshi are going to take over, then the market's right. Now, what do I think is going to happen? I think DraftKings is going to be fine. Now, these are not my favorite investments. I'm not a big gambler, so I'll leave it up to somebody else to maybe invest in DraftKings, and I'll stick to buying Meta and other types of social apps. So that is DraftKings. It looks like the stock is under pressure. I think it's rational. It's reasonable to see the stock get sold off because they came in with really slow growth. If you don't grow, the market's not going to be excited about your stock. So that's it. So it's pretty rational to see the stock sell off tonight. That is DraftKings. All right, so we covered DraftKings. Let's cover ELF. ELF, I think, is Beauty. ELF Beauty. All right. Whoa, man, that is a stock that I noticed today. Down 35%. Oh, man. Look at that. Oof, fell off a cliff. $4.55 billion market cap, revenues of $1.4 billion. The forward PE is 24.45. What is going on with the business here? Are they growing? Are they contracting? So it looks like the growth is pretty decent, 14.24. How is profitability? So they lost money. Yep. And you see that if we follow, this is the quarterly. So the revenue looks okay. Cost of revenue looks fine. Gross profit line looks fine. The selling, general, and administrative. What it looks like it's been increasing. So, but not like a glaring problem. So sequentially, the revenue dropped. See how like last quarter, they actually had higher revenue. That's happened a couple of times in the last 4 quarters. Here sequentially, it dropped, it rose, it dropped. So they have definitely plateaued. So I think investors are thinking that ELF is going to stop growing. And if they stop growing, their valuation changes and they will not be provided a very high PE ratio. This stock is under a lot of pressure And that pressure, I think, is reasonable because they're not showing signs of growth. Their gross margins are fine, but profit margin for the current quarter was terrible, 0.87. All right. So the forecast, we've got 16 analysts covering it. Some analysts are really high on the stock. All analysts think it's a pretty decent stock. You have an analyst at 75. He probably thinks that he nailed it. He did. All right, 71% discount. I'm sure those analysts are going to update their price targets because I think the whole valuation on this business has changed. Now, if they can continue to grow, it looks like they're in the year that's going to end March 31st, 2026. I don't know if they're going to hit that growth forecast. But I mean, if they grow at these levels and they can increase their profitability, this might be an opportunity. But I'm not a big beauty investor. I don't claim to have any kind of insight into this industry. If you do and you kind of get this space, it might be an opportunity because this stock is definitely under pressure. It's rising a little bit in after hours, but man, this has just been a wild ride, huh? You have a stock that really sold off when everything else was selling off. It rose and then it dropped again. Incredible. So Elf Beauty had a rough day. I think some of it was deserved. I don't know if it was a 35% drop day, but it looks like, just investors are afraid of the stock. Small caps tend to be punished. Small caps don't hold their value like these big caps do. It's because of name recognition. Also, Elf Beauty is in a market, in an industry that's really competitive. You have all kinds of companies that are in the beauty category trying to outmaneuver and steal customers away from one another. So the competition is tough. A lot of heavy advertising. They have to pay celebrities to be spokespeople so that they could push their product. So all that, is something that I don't quite understand, and it's not that attractive of an industry to me. I'll stick to the industries that I think I understand well and have made money in. So that is Elf. Hopefully you found that interesting. Thank you for asking. All right, let's move over to Snap. And Snap is the social media company. Snapchat, they are a company that would have liked to compete with Facebook way back in the day, but they didn't. They kind of didn't. They didn't establish scale. They didn't get as big. They didn't get momentum. The year to date still down. The 1 year still down, even though they went up 9.7%. This is a $13.77 billion market cap company with revenues of $5.77 billion. Their forward P looks pretty decent at 22.58. Analysts think there's a discount available on this stock. Looking at their growth, this looks pretty decent. So they're growing. Looks like they are growing. All this green looks good. Growing at about 10%. Looks good. And when I do a trailing 12 months, so I can look at their cash flow for the trailing 12 months, $414 billion. At their growth rate, gross margins of 54%. I'd probably value this company at $8 billion total minus debt. See how much debt they have. And they have a little bit of debt, $1 billion. So I think this business is worth about $7 billion based on cash, and they're above that. When we look at their earnings per share valuation, 25 analysts are putting a price target out there, and they think it's 28% discounted. When you look at their growth, that's pretty decent growth. It's really growing its earnings per share, but it's not a big number. So overall, this is not a stock that I'm interested in because there's better investments. I'd rather buy Meta or Pinterest or Reddit. Reddit's really kicking butt and taking names, growing at 65% top line revenue. So I'd rather buy into stocks like that have so much good momentum. They have terrific fundamentals. The fundamentals on Reddit are way better than Snap. And Pinterest, their profitability is way better than Snap. And Pinterest got beat up yesterday. So, and it bounced back some today, but boy, it went down 21% and it was really beat up yesterday. In fact, I'm going to look at Pinterest later. We'll take a look at it. And that is Snap. In fact, let's do this. Since we got Snap fresh on our minds, let's take a look at Pinterest. And like I mentioned, Pinterest yesterday just got beat up. It dropped. And actually 2 days ago, it dropped. And then it picked itself up a little bit today. And it was up upwards of 5% for part of the day, but it was a sell-off day. And it looks like it's trying to rally back. I bought more shares. This is a $17.75 billion market cap company. Look at these PE ratios, really low. You would think these guys are growing very little or not growing at all. Analysts think it is very discounted. And when you look at these fundamentals, I really like what I'm seeing. They announced their quarter and they grew by almost 17%. And the market didn't like overall what they saw. Now, there was some write-offs that I think brought down their profitability, but their free cash flow is terrific. Their balance sheet's terrific. And their gross margins, awesome, 80%. Very good. Very good free cash flow yield, very good profit margin. So I really like Pinterest and bought more shares. I don't own a lot of shares, but I bought some more shares because I think the market, I just don't understand why it sold it off. Maybe because it's a small cap and there's fear in the marketplace right now. Maybe. Analysts, 30 of them, all price Pinterest at a higher price target. Some analysts are saying that it's worth $50 a share. And I agree with them that it's highly discounted. It's supposed to keep growing. These growth rates are very good. And I showed you their gross margins. They're going to make lots of money. And this is an acquisition target. You think about Pinterest, it has a lot of users. Its PE ratio is going to really drop, but I think the stock is going to rally at some point and really pick itself up and be at least a 20 PE stock. So Pinterest, I think, is an opportunity. It's highly discounted. I did my homework on Pinterest. And I think it's nicely discounted by 67%. That's a big discount. And look here, I got Snap, 20% discount. And it doesn't have a big value because of this cash flow. You see the cash flow difference? Pinterest is 3 times the cash flow. Profitability, one's way higher, like 6 times higher than the other. So I'd rather be an investor in Pinterest and avoid Snapchat just because the fundamentals are far better in Pinterest than Snapchat. So it's cool that you asked about Snapchat. We got the combo. We got the Snapchat Pinterest combo, and hopefully you found it interesting. Thank you for asking. All right, let's move over to Workday. Workday is a software company. Let me make some room here. I'm going to have to get rid of this guy. So Workday, they're probably best known for human resources software. They offer a very impressive suite of applications to manage human capital, people, HR. And they also do financials and other types of business processes for a business. These guys are a $59.9 billion market cap company, revenues of $9 billion. Very high PE ratio for the current year, dropping to 23.5. So it looks like their profitability is really going to expand. Analysts think it's discounted by 27%. Year to date, this is down 13%. For the 1 year, down 7%. Has not been a stock that's gotten it done for the 5 year. This is dead capital, just capital that just sat and did nothing, which is unacceptable. Looking at the growth, we have good growth quarter after quarter, Really good, consistent growth. That looks good. Let's take a look at their cash flow and their free cash flow. Call it 2.4 billion. Very good cash flow number. Gross margins of 75.5%. Very good gross margins. Free cash flow yield is very good. Profit margins are not very good. So the company is doing all right. It's not doing great. It's just doing all right. 29 analysts cover it. Some analysts think this stock ought to be priced at 345. It's currently at 224. The worst price target is at 235, higher than its current stock price. Now, on a day like this, Workday did sell off because most other stocks sold off, especially the software space has not gotten very little love from the stock market for the last 2 years. And this stock is a software stock. It's going to keep growing. 12.6, 12.4, 12. That's very good growth. They're becoming a pretty big company. And earnings per share is going to grow even faster than that top line growth. Forward PE looks good. I think they deserve to be at a 20 to 24 PE, and I think their stock price will rise over time if they could really execute their business and continue to grow. So Workday is a good idea, but I think there's ideas out there like Salesforce, Adobe, ServiceNow that are also discounted. Take your pick. There's really good choices in software because they've just been beaten up for the last couple of years. They've gotten very little love from the market. The market's buying up data center stocks and semiconductor stocks and energy producing companies and so forth, and kind of left software stocks that are really attractive businesses off to the side. So that is Workday. I hope you found the analysis interesting. All right, so let's move on. Check out the comments, and then we'll get on to the next stock. Looks like I'm caught up on comments. All right, very good. So the next stock that I wanted to cover is, let's go to Robinhood. So Robinhood was sold off today. They had very good earnings. Their earnings were really, really good. When you look at this business, they grew year over year by more than 100%. Customer accounts grew. They have this subscription on their platform, the gold subscribers. But when we look at their revenue growth, they grew 100%, sequentially grew 29%. They're actually taking advantage of the whole predictive markets and excitement, and they've partnered with Kalshi and provide that functionality on their website, and they're doing really well. They're selling a lot of contracts, which is how you sell in the prediction markets. This earnings was excellent, fabulous, awesome, but the market sold the stock off because it's a stock that's been going up so much. So I can't argue with the market saying, okay, enough's enough. We got to bring the price down. Okay, I get it. But the earnings were really good. So if it comes down a little bit, that's fine. I've got a big position in Robinhood. I'm sitting on a huge gain. So if it has to come down a little bit, so be it. I've seen it before, like here and on other occasions, and I just sit tight. I own so much, I probably wouldn't buy more shares, but I'll just watch. It's a $114 billion market cap. It's now part of the S&P. You do pay a high PE for Robinhood, and analysts can't keep up with the stock. They think it's priced 6% too high. The growth is where the excitement really is with Robinhood. You see this growth, 100% for the last quarter. These numbers are really, really exciting, which is why Robinhood is really flying up. So Robinhood's been a really good stock for me, and I'm glad that it's done so well. 21 analysts cover it. The high is at 172, the low is at 47. And the revenue is going to continue to grow. These numbers, I think, are light. I think they're going to grow better than that, especially if the market keeps rolling, it keeps going up. Robinhood's going to be just fine. It's taking over like the mind share of financial services. All the old school financial services companies, the brokerages, they don't know how to compete against Robinhood. Robinhood has it. They've got momentum. They're getting all the younger investors, and it's pretty neat to see. So Robinhood had very good earnings, and their stock sold off. Understandably, the stock's just so darn expensive, so I'm good with that. And that is Robinhood. All right, so and you are correct, sir. Hood is part of the S&P 500 now. They were added, and they are part of it. So is AppLovin and a couple of others. So that was Robinhood. Qualcomm, they had very good earnings. The story on Qualcomm, they're primarily their revenues come from mobile devices, the iPhone, the Samsung mobile phone, but they're expanding to be installed in cars, Internet of Things, robots, all kinds of things that are neat. AR glasses, all those things. That's where Qualcomm is found. And they grew really well. Their revenue grew well. They are having a decent year to date, 12.75. They pay a 2% dividend. The 5-year, not so good. It's been all over the place. Hasn't kept up with the big semiconductor play of NVIDIA and Broadcom. Those guys have flourished. These guys have not. Quarterly growth has been really good if you look at the last 8 quarters. So that's impressive. And the last quarter that they just announced, they grew by 10% on a big number. They have very good profits. They generate a ton of cash. Cash flow is off the charts. Good gross margins, good profit margins. Although their profits did dip. I think that's why the market didn't like. They didn't give them an A+ grade because their profit margin dipped. They had some write-offs that kept that number lower. So if they can get back on track and come back with a nice 27 profit margin next quarter, this stock's going to be fine. Good long-term hold for me, and I'm going to buy more shares of Qualcomm. So this stock here, good earnings. Then the stock market really sold it off. So that was interesting. All right, last one is going to be kind of a weird one, and that's Duolingo. So Duolingo, their earnings were pretty good. So they had good revenue growth. So I can't say that the market didn't like their revenue growth. Their free cash flow is good. And so they had monthly active users grow, bookings grow. I think there was some comments that bookings didn't grow enough. Okay, 36 looks pretty good to me. Revenue is growing 41%. Seems like a really good growth rate of 41%. I mean, come on, that's really good. So Duolingo is just kind of getting abused out there because the stock dropped 25%. And again, I was trying to look for what's the big reason as to why the stock would drop so much, but I'm coming up empty. I'm not quite sure. And I think it was the bookings number that investors didn't like. I think they were looking for any reason to sell this one off because the story is that AI is going to hurt this business. Now, that's a rational story because Duolingo does basically, it's an app where you can learn languages and you can learn things on it. And they're thinking that AI like ChatGPT and Gemini are going to enable you to learn another language. That might be the case, but I don't think it could do it right now. And Duolingo continues to grow. I showed you their growth numbers. Growth numbers look terrific. So the market is kind of making up reasons to sell off this stock. And to me, that's an opportunity because money's money, profit's profit. So if these guys keep cranking out this kind of cash flow with these kind of margins, this stock at some point is going to revert back to its intrinsic value, the value of those cash flows and those profits. So I think this one here, it's a really small position in my portfolio, but I think I'm going to buy more shares. I think this is going to be a nice little long-term opportunity, but we'll see how the market, changes its mind around this stock. Might take a little while, but it's been taking a little while. Look how the stock really performed coming through 2025. It was doing great. You hit a peak here in May timeframe, and it's really come down from 529 down to 193. Interesting that that's happened. So I think Duolingo, the minus or the sell off of 25% on their stock price does not match their earnings report. And I think as we started the stream, somebody was saying that, hey, DraftKings, the earnings were good, but the stock sold off. I could say that about 20 or 30 stocks that I thought the earnings were good, but the stock sold off. And it's like, interesting. And I think the market just thinks, you know what, stock prices are expensive and investors are selling out. Maybe they're sitting on good gains and they're ready to cash in. Who knows? All right, moving along. Looks like somebody's interested in Celsius. Let's take a look at Celsius. So Celsius came back from kind of being written off. The market at this point here, Monster took over some of their main contracts, which put Celsius kind of under pressure. They weren't able to grow as well, but they've come back nicely over the year to date. This is up 71%. This is a beverage company. It's one of the energy drink companies, and they're an $11.6 billion market cap company with revenues of $2.13 billion. P ratio next year looks pretty decent. Now, this industry doesn't have the biggest margins you can come across, but you see that revenue drop. That's when Monster came in and took away one of their key contracts, one of their key distributors. And that was the big problem, but they started to grow again. They had a contraction. Now they're growing again, which is why the stock's up so much. Now they're really beginning to grow. So kudos to the team over at Celsius. So to figure out how they can start growing. That is excellent. The earnings per share really dipped, hasn't really come back. Free cash flow, the trailing 12 months isn't showing me a number, but 210 for the quarter before. These guys don't cash flow a whole lot. They have gross margins of 50%, but then they have to spend a lot of money on advertising. It's a beverage company there's a lot of expense when this type of business. I seldom hold beverage companies because they just don't get a lot of the profit down to the bottom line. These guys are growing well, and that's what you're buying is you're buying growth, but in a business that I don't find all that attractive. It's a beverage business. So these guys, the stock has been moving. It's a really small cap. When we look at the forecast for them, they're going to keep growing through 26, and they're going to have to figure out how to grow beyond that. Their profitability is going to expand, and their PE ratio should drop into the 20s. I'm not a big fan of beverage for the comments that I had, which was margins aren't as great. I think it's hard to grow because you're making a product physically. And you have competition like these guys faced. Monster came into their market, took away one of their key distribution channels, and the stock really plummeted. So that will continue to exist. There's risk in the marketplace of these guys being taken over, so to speak. They're not Coca-Cola. They don't have that kind of brand. These guys are having to just work a little harder, hustle a little harder, and outperform their competitors to be relevant. They dropped 24.8%. It looks like they announced before the market opened. And it was probably because of growth. What do we got here? So distribution, Celsius stock has much bigger concerns than distribution transition. All right. And what would we see in their financials? So if we go quarterly, so the growth is there most definitely. But the compare, I think this is because this quarter was so bad, it kind of dropped 31%. So then when you compare against it, yeah, you have a very good looking number. All right. Cost of revenue. Yeah, I don't know why they would go down. That's a pretty good growth number. But again, they have tighter margins, and I just don't see myself wanting to own a beverage company. Here's one of the reasons is, man, the total surprise. And it was a total surprise when Monster took away that big distributor. I think it was a year and a half ago. So Celsius under pressure. All right, so that is Celsius. All right, so covered that one. All right, so what do we have in store for tomorrow? So we have the futures market is a little green. Okay, so I guess we're going to have a red day, green day, red day, green day. But the red days this week have been, they've had greater magnitude. They took stocks down harder than they recovered on yesterday. So we'll see. Fingers crossed that we can have a decent day going into Friday. Next week is going to be a shortened trading week because I think Tuesday the market's going to be closed for Veterans Day. I think it'll be open Monday, closed on Tuesday, and then reopening on Wednesday. So that's what's going on there. In crypto land, Bitcoin is up just a tiny bit, but it is just hanging out a little above $100,000 per coin. Asia yesterday was up nicely, or I'm going to call it yesterday because now it's already tomorrow in Asia. And stocks are trading lower. They're probably picking up where we left off. And looks like Shanghai is down. Hong Kong is down. In Japan, their stock market is down. And Europe is closed. It'll open up in several hours from now. All right, so that's what we have in store for tomorrow. And I think I've gotten to all the points that I wanted to make. And that is it, folks. Well, thanks for joining me. It's good to have an evening stream for those that like to watch, maybe on the West Coast, like to talk a little stocks. And it's great to have you. Thanks for joining. If you'd be interested in joining this channel, I think it's really worth it. We have a good community of investors growing, and you can join for as little as $10 a month. $25 a month gets you to the advanced level. I share my tools and my research with advanced members, so you have access to my research. I save it, and you're able to access it 24/7. You also get advanced investor videos. If you want even more access to my research, as well as some of my trades that I'm making a daily, super investor level would get you there. You also get to nominate more videos for me to analyze. And then platinum investors, for somebody that really wants a lot of research done each month, that level is available. So think about it. If it's something good for you, I think you'll get a lot of value from it. All right, everybody. Have a great night. Thanks for tuning in. I will talk to you soon. I'm streaming tomorrow morning with Daryl. If you want to join us in the morning, starting at 9 a.m. Eastern, 6 a.m. Pacific. Have a good night, everyone.